Have you ever wondered how exporters finance their operations? Today, we are diving into the world of packing credit loan. Let's break it down. A packing credit loan is a short-term financing facility that banks provide to exporters. Its primary purpose is to finance the purchase, processing, manufacturing, packing, and shipment of goods meant for export. But why is it necessary, you ask? Well, it helps exporters bridge the gap between the time they incur expenses to produce goods and the time they receive payment from overseas buyers. It's like a safety net, ensuring that exporters don't fall into a financial abyss while they wait for their payment. This loan is typically secured by the export orders or letters of credit received from foreign buyers. So, a packing credit loan is essentially a financial lifeline for exporters, ensuring their operations run smoothly. Within the packing credit loan, there are two main facilities, the running account and the order-based facility. But what do these terms mean? Let's start with the running account facility. This is a type of arrangement where the bank provides an exporter with a pre-approved credit limit. The exporter then has the freedom to draw funds as needed up to this limit for various export-related expenses. This could include procurement, manufacturing, packaging, and shipping. It operates much like a revolving line of credit with the ability to make multiple withdrawals and repayments within the sanctioned limit. The interest is only charged on the amount utilized, and as repayments are made, the credit limit is replenished. This flexibility allows for continuous access to funds throughout the export cycle. On the other hand, the order-based facility works a bit differently. Here, the bank extends credit to the exporter based on specific export orders or contracts. Each order is evaluated separately, and the bank disburses funds according to the requirements of each order. The credit is usually linked to the specific transaction and may require documentation as collateral. Once the order is completed and payment is received, the loan associated with that order is repaid, and the facility may be renewed for subsequent orders. These facilities provide flexibility and control to exporters, allowing them to manage their finances effectively. Now, there's often confusion between export packing credit (EPC) and pre-shipment credit in foreign currency (PCFC). Let's clear that up. The primary distinction between EPC and PCFC rests in two areas: the currency denomination and the use of funds. Firstly, let's talk about currency denomination. EPC is typically denominated in the local currency of the exporting country. It provides working capital in the domestic currency to cover export-related expenses. On the other hand, PCFC is denominated in a foreign currency, often one commonly used in international trade like US dollars, euros, or pound sterling. It provides financing in foreign currency to cover export expenses. Now, moving on to the use of funds. Funds obtained through EPC loans are used to finance various export-related expenses incurred before the shipment of goods. This could include procurement, production, packaging, and transportation costs. Conversely, funds obtained through PCFC loans are also used for pre-shipment expenses, but these are specifically designated for expenses that are denominated in foreign currency or where payment is made in foreign currency. An example would be the purchase of imported raw materials or components for export production. So, while both EPC and PCFC are integral to the export process, it's essential to understand their differences. Both serve similar purposes of providing necessary capital for exporters, but their differences lie in the currency used and how the funds are allocated. While both EPC and PCFC serve similar purposes, their differences lie in the currency used and how the funds are allocated. You might be wondering, why would exporters prefer an EPC or PCFC loan? Well, the answer lies in the many benefits these loans offer. First and foremost, both EPC and PCFC loans provide essential working capital support. This means they provide the necessary funds to cover export-related expenses, such as the purchase of raw materials, production costs, packaging, and shipping. Moreover, EPC loans offer the advantage of financing in the exporter's local currency, which helps manage currency risk and provides stability. On the other hand, PCFC loans are denominated in a foreign currency, allowing exporters to meet expenses that are specifically denominated in foreign currency. These loans also offer flexibility, as they can be utilized according to the exporter's needs and as per the requirements of the export order. In short, EPC and PCFC loans are crucial tools that support the financial needs of exporters worldwide. They ensure that the world of trade keeps spinning smoothly.